Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have two guests this morning. Firstly, Graham from Canada. How are you doing, Graham?
Good, John. How are you?
Very good, thank you. And Gaurav in his new home in Sydney's leafy North Shore. How is the weather in your new house, Gaurav? You getting
Do you know the most frustrating thing? For the second time in 3 weeks, my 8-year-old just walked out the door without his school bag. That's walked out the door.
Normal, isn't it?
No school. Really? Oh, I find that incredibly frustrating. But apart from that, John, all is well.
All is well, apart from Gaurav's son, who is school bagless this morning.
You'll have to explain that. Is that because the schools don't have them, or
No, because he just walked out because I'm trying to teach him
just
organization.
confidence?
So, I want him to bear the consequences of not having. I want to be not like the US government and make sure if you make a mistake, you pay for it. You feel the consequences of it.
I like that parenting style. Yeah, learn by consequence.
Oh, yeah. It's very much out of fashion.
Well, the school called me all worried and said, "Oh, Ethan forgot his bag. Do you want to come drop it?" And I said, "No, make sure he goes hungry. Don't give him any plates. Don't give him any food.
Perfect.
I want him to feel it."
Then you had a knock on the door from the police.
This is the great thing about Stocktake. You get parenting tips as well.
Yeah.
Okay, so from the everyday to the slightly unusual case of Pilbara Minerals, now called PLS, Gaurav, we've had a long history with this company. I think I'll introduce this to listeners by talking briefly about that share price history. I think this was a buy about 2 years ago at a price of around $350. We then reiterated that as the price fell. Most recently in March of this year, when it fell down to 183, and the price the price actually fell even further to 114, so almost a third of what it was just a year and a half ago. And since then, since July, the price has risen from about 114 to over $3. Now, this week, you put a sell on that stock, Gaurav, which is, and the price hasn't yet recovered to the price that we bought it at. So there's been a change in the investment case. Maybe you could kick this off by talking about why we decided to buy Pilbara in the first place, and then how investors should approach what kind of mentality investors might need to deal with a stock that they've bought that is falling in price steadily but surely.
Yeah, it's my belief. Look, I'm a firm believer that investing is an individual pursuit and different styles suit different personalities. So I want to say I recognize there's plenty of ways to make money in the market, but what's really worked for me is a contrarian approach. And in commodities, I think that's particularly well rewarded. What you want to do is buy the best assets at times of distress. Now, distress in commodities is difficult because everyone can see when the price is falling, but prices generally fall much further than anyone expects they will. So you have to be prepared to buy a little bit, watch prices fall, buy a little bit more, and watch prices fall. That's the approach we've taken for 10 years at Intelligent Investor. We've seen it through numerous recommendations, for all the way from sort of Whitehaven and New Hope down to South 32 and BHP and gold stocks. We've seen this at work before. So it was no surprise really that when lithium got on the nose 2 years ago and prices sort of halved and fell by even more, that we started looking at the best lithium assets. And there are two lithium assets of note in Australia. One is Greenbushes, which is the best hard rock mine in the world. The reason I looked at that very, very closely, did a lot of work on that mine, extraordinary ore body, easily the best hard rock lithium mine in the world, but it's stuck in a convoluted ownership structure where IGO, a listed business, owns 25% and it's majority owned by a Chinese producer who is not interested in maximizing profits. And I just think it was a bad way to invest in lithium. And not far from Greenbushes, you have this fantastic ore body called Pilbara up in the Pilbara. And Pilbara Minerals owns 100% of that ore body. This is a fantastic example of a spodumene mine. It's been running as a tantalum mine for many years, and with fractured ownership. Pilbara took that ownership and consolidated it, and they understood that geology really well. It's got all the characteristics we want from a spodumene mine, which is thick, easy to access intercepts. Spodumene is a crystalline structure, so you need crystals that are nice and thick and easy to manage. And processing of spodumene can be complicated, and so you have to experiment for a few years to get the processing right. And I was particularly waiting for signs that Pilbara had nailed the processing, and when I saw that, I was happy to pull the trigger. It turned out it was too early.
Okay, so how do you approach that personally? I'm going to ask Graham this question as well. When you feel as though you've bought a stock, it represents good value, and then the price starts to fall, and the business really doesn't change that much.
Yeah, I almost expect that to happen now. I think if you're buying in the price, if you're buying a stock and you're doing it right, you're buying at a moment of potentially crisis, when things aren't going well, when others are hating it. And so the trajectory of the share price doesn't change just because you decide to buy it. So we should get used to buying stocks that are falling and that will continue to fall. It's just part of my process now to start taking positions in stocks and expecting them to fall further. And that should be seen as an opportunity to gradually increase your position in a stock. I think a mistake that rookie investors make is that they launch into a position at full scale, and I think it's a bit more nuanced. I think what you want to do is begin position sizes small and gradually build them up as your thesis is being proven or as the opportunity gets better. Very rarely do you get a chance to buy a full position in one shot, and I don't think that's a good idea. So, I mean, we tried to make that clear. I remember specifically talking about this in the first article, saying that this may well go lower. You want to start. This is a first position and make it a small one and build it up from there. So I hope that message gets through for members, and it with experience, I think it become even clearer.
Graham, what's your thought? Because this process is called averaging down, and I think it's quite useful for people who do practice value investing, because often value emerges and the value tends to increase as prices go down. So we have found, like over the last 25 years, I would say that it's quite common for us to recommend stocks that we end up making a lot of money on, but we end up, the first couple of years are pretty painful because the price continues to fall. And averaging down is a way of dealing with this. Graham, is that something that you practice in your own investing?
Yeah, definitely. I think that you're right. I would say that it's nearly universal that a stock will go down after you start buying, just because what are the odds that you've picked the lowest possible price? So I can't think of a stock that I've bought where it hasn't gone down briefly, and sometimes not so briefly, straight after I buy it. So you can, it's also a reminder that you don't have to panic. I think when you're first buying a stock, there's always this little feeling of a fear of missing out because you've discovered something. You feel excited about the new company you're about to buy, or that you feel it's undervalued. And so you want to kind of pile in quickly before the opportunity goes. But I've never found that the opportunity goes that quickly, that you've always got a bit more time than you think in most cases. So I don't see the rush. And I think averaging down, I think Gaurav said it very well, where you can start off with a position and then build it as the thesis proves itself, that there's kind of a balance there. You don't want to wait for it to completely play out, obviously, but at the same time, getting the reinforcement from other numbers doing what you expected them to do in terms of the company's fundamentals, not the share price, and then adding to that, if it is being reinforced, that seems pretty sensible to me.
Can I give you an example of how I did this? Actually, when the coal stocks were firing, I actually made my first investment in Whitehaven at about $1. Okay, and that was a very small position size and I felt sick when I made it. And I think the best investments should provoke sickness, not glee in you. Yes. you should feel awful when you're making a really good investment.
Fearful.
You want to be
it's the right thing to do. That's a good signal when you feel
but
like that.
as the thesis was proving up, as the debt was being extinguished, as free cash flows were building, Whitehaven didn't stay at $1. I bought most of my stock in Whitehaven between $3 and $4, and it ultimately became sort of a 30-40% position size for me. But I bought most of it at $2 or $3. So I was buying most of my stock, so 2x, 3x my initial position size. And I think that's the way I would approach that. And ditto with Lovisa. I bought my first my lowest cost tranche of Lovisa came at under $3, and my highest cost tranche of Lovisa came at about $25. So I was buying 10x at my lowest purchase price. And I think I want to encourage investors to have that kind of flexibility, to forget about your previous purchases and just keep an eye on price and value at every stage, because information changes. And to bring this back to Pilbara, that's exactly what prompted the sell. I mean, the share price has gone from...
I'm glad you brought it back there after going through Lovisa and God knows what else. Because we have sold this company last week, and your argument is that the investment case has changed, right?
Not so much that it's changed. I think the payoff structure has changed. The investment case is very simple, and it's exactly the same. The lithium has been absolutely smashed. Current prices are too low to be economic. And for the industry to survive, they just need higher prices. Pilbara has the second lowest cost mine in the world of spodumene. And it will make a loss this year and next year. And the share price was up sort of 45-50% since January. So, the prices are too low. But we went through the article, and there are very specific reasons why I'm starting to wonder whether prices will actually recover.
Can you explain why that is? Because it's quite an interesting argument, I think.
Well, you expect, as an investor and as a producer, as a miner, you expect rationality from other miners and other producers, right? You think that you expect others to plan their mine output, trying to maximize profits, trying to make money.
Right.
But every now and again, there are other incentives that override the money-making incentive. And I think that's what's happening in lithium. China has come in and completely dominated the supply chain for electric batteries, for EV vehicles. That means that they are vertically integrated into the mining and the processing, the construction of batteries, and the sale of batteries. CATL is the largest battery maker in the world, surpassing Tesla. All the processing is mostly done in China, and even the mining a lot of it is done in really lousy quality mines, known as lepidolite ores. Very low quality, very low grade, expensive to dig up. You have to remove a lot of dirt, produce a lot of byproduct. Those can't be making money. I've done the math on it. The amount of ore you're moving, unless you've figured out some miraculous way to shift lots of tons of ore at extremely low cost, which I can't find an example of anywhere in the world, those mines cannot be making money. And yet the Chinese miners are willing to sit there and wear losses at the mining stage if it means dominance at the end battery stage. And I think those integrated supply chains completely change the game for lithium.
So why would Pilbara be increasing its output during that kind of time? Wouldn't that be when it should be pulling back?
Yeah, Pilbara is unusual. I think they're doing the right thing there because their ore body is a enormous, large ore body. There's probably 50 to 70 years of mine life in Pilbara and Gaurav. It's so large, they've stopped exploring. There's no point putting more resources into the ground because they have decades and decades of mine life. Now, when you have such a large continuous ore body, you can employ bulk mining techniques. So the more ore you can extract, the lower your unit costs. So as the price of lithium has been falling, the only way for Pilbara really to stay competitive is to counterfactually kind of increase their production because it lowers their unit costs. And they're in a unique position where they can do that. Most mines cannot simply increase production because it comes with high marginal cost. These guys have sort of a large continuous ore body where the ore body is simple to scale. And so they can take advantage of that scale. So it's an opportunity unique to Pilbara. And it's one of the reasons it was on the buy list. And look, I still think there's a very good shot that that demand for EVs continues to accelerate. I think I saw the latest numbers that came out showed that there's a 40% increase in EV sales globally. We're not seeing it here in the West, but in Asia, in China in particular, EV sales I think 95% of marginal sales are all EVs, and it's the largest car market in the world. So there's every chance that higher demand eventually pushes prices up higher, and Pilbara is perfectly positioned. Huge amount of net cash, lots of operating leverage in that mine, a second operation that can kick in and take advantage of higher prices. It's perfectly positioned. But the bet you have to consider is, what's the payoff structure like? It's still a $10 billion business that will make no money over the next 2 years. Lithium prices are very slow to recover. There's no signs of supply exiting that industry. So I think if we can sort of take our money, and most members I'm hoping would have actually made money out of this. If you had fired all your bullets, you're sitting on a small loss, so 5% loss or so, which is, I think, if all my errors were a 5% loss, we'd be doing great. And I think it's fair to acknowledge that this was a recommendation that hasn't really worked out, even though I would say most members have probably made money out of it because they've averaged down. It isn't a recommendation that we count in our success pile, and it hasn't worked out.
I would say to listeners as well that there's an important point here about investing in markets where the Chinese play a major role. The Chinese are playing a very long game. They think very strategically, and they're prepared to lose money in order to control a supply chain and a value chain. And we've seen that. We've seen that in a number of industries. We saw it initially in solar panels. We saw it in batteries. I think lithium is a part of that. And I think there's a possibility we might see it in AI down the track for reasons that I could go into, but not appropriate for this podcast. We've already spoken about Gaurav's kid going to school without his bag. We don't need any more diversions. But this is an important consideration. If you're investing in Western markets, you're investing knowing that almost certainly the people managing those businesses are doing so to make a profit. That is not true when you're investing in markets where the Chinese play a big role. They are investing sometimes to lose money to achieve a bigger strategic purpose. And the West has been very, very slow to wake up to this in rare earths. They've been doing this in rare earths for 15 or 20 years, and under the Western now is only waking up to it. And you could make the same argument. This is what is happening in lithium too. So I think that's just something that people need to be aware of. So Pilbara for us is now a sell. It's quite possible the stock price could appreciate from here, but for the reasons Gaurav's explained, we just want to steer clear of this kind of complicated investing environment. Where we do have more confidence is in buybacks and discerning whether some buybacks are good and some are stupid. Graham, you published a story last week on smart and dumb buybacks. We've got 25 ASX listed companies that are doing buybacks right now, or have announced them, or have recently embarked on them. Tell us what a buyback is, because there was a time when they were illegal, weren't they? Wasn't it?
Whoa, really?
In the US, buybacks were illegal. Yeah, I don't know whether they were here, but they were outlawed because they were seen as a kind of manipulation.
I guess you can see how that would have been the case back in the 30s or so, when people, like when the shareholders they would have been buying them from were buying them at such a discount to the stock's value, could see as stealing money from the shareholders or something or other.
Right.
Well, to explain what they are, it's where a company is able to buy a stock just as you buy a stock and own it, but the company itself is using its own cash to buy its own stock. And when that happens, it's able to retire the shares that it's purchased, which then just means the share count goes down. And so everyone gets a slightly higher stake in the business. So it's kind of like they shrink the pie a little bit, but everyone gets a larger slice. And so
why would you do that? Why would you do that rather than just pay the money out as dividends?
Well, in Australia, there is generally a preference to pay them out as dividends because of how they're treated with tax. But you can still, there are situations where the buyback could add even more value than the dividend that it would be paying out. Because if you could buy the stock, let's say an imaginary company had 100 million of cash sitting there, but its shares were trading where, at say 50% of the net asset value behind it, then the company could essentially spend $10, say, and then get $20 of value, and then everyone's stake in that company goes up. So it might end up, depending on what the value of the company is and what the value of the share price is, it might end up being that it is a good thing for shareholders to use the cash in that way rather than just distributing it as the straight dollars and cash. But yeah, what it depends on is the valuation of the company. So there are all managements will universally say when they're conducting a buyback that it is a smart move and it's good for shareholders, but it's actually completely neutral as a tool. What matters is the stock's valuation. And so you've got good buybacks and you've got really dumb buybacks. And that all comes down to actually valuing the company and then comparing that to what the price is that they're getting for that stock that they buy back.
So give us a couple of examples of some smart buybacks and a couple of examples of some dumb buybacks.
Well, one of them, typically a buyback is smart if you're buying it at a big discount to the stock's intrinsic value. And you can't always figure out what that value is too precisely, but the bigger the discount, the more value that the buyback is adding. So basically, any stocks that are on our buy list or on our hold list tend to be in the good camp. They're smart buybacks. And those, when we recommend a sell or an avoid on the stock, we think that the stock is overvalued. And then any chance that the company is taking to buy back its stock at that price is ending up destroying value for shareholders. So a good one, an example would be ResMed. It's trading at only a slight premium to our buy price of $35 or so. And although that's not as good as it would have been if it was still in buy territory, each time that it's making those purchases, it's shrinking the pie a little and adding to the slices for the remaining shareholders. So this is a good company. It's going to last a very long time. It's a very high quality business on the ASX and with pretty decent growth prospects. And we're getting at a discount to what it's worth. So the more that the company itself is able to buy back stock at these prices or even lower, which would be better, then that'll just accelerate the earnings per share growth because you've got an even quicker shrinking share base.
Right.
And in terms of a bad one that comes to mind is the Guzman and Gomez one, where that seems completely devoid from valuation.
That is unbelievable, man. I've never seen anything like that.
You can think of a buyback as being the opposite of a capital raising. So when a company is raising capital, it's saying, I'm going to sell you shares and you're going to give me the cash and I'll then use the cash to build a factory or whatever. And so Guzman essentially did this earlier in the year last year for at $25 or so. It was issuing stock for $25 and taking that on. And now it's buying back the company at I've got it the other way around. It was doing that at 22 and now it's buying it back at 25. So it's essentially repurchasing stock at a 15% premium to what it sold them for just last June.
But think of all the increase in value in the meantime, Graham.
Well, that might be their argument. The other argument is that they're doing it just because their own management's own IPO issued stock is now out of escrow. And so they can use this as a way to boost the share price a little while they're selling their stock. So there are all kinds of different reasons that companies will do buybacks, and some of them are unfortunately to the benefit of management instead of the benefit of shareholders.
Okay, so you produced a list, Graham, of about 25 ASX listed stocks and called some of the stocks on that list smart or dumb. Telstra was one of them. Gaurav, you're our Telstra analyst. Why do you think Telstra is doing a dumb buyback?
Yeah, it's just expensive, John. We've got a sell on Telstra after buying and holding it for quite some time.
And doing well out of it.
And we did well. It's not a stock expected to do well out of, but it actually did do very well. Telstra ought to be paying, and historically has been paying dividends. They've got quite a large franking balance, but they've also got a huge debt pile. And it is relatively high quality business. They have very stable cash flows, so it can handle debt. It's not as if the debt is crippling or threatening, but as a investor myself, I would prefer to see, rather than buying back at sort of 30 times earnings, I would rather see either debt fall or dividends rise. the case for not paying dividends is that Telstra is aware that its shareholder base is largely retail, a large retail shareholder base, and they want to provide steady dividends. They don't want the case where dividends kind of rise and fall inconsistently. They want a steady dividend paid out. So in times when they have excess cash flow, the default, I think, unthinkingly just becomes, let's just buy back stock. They don't think about paying a special dividend or they don't think about retiring debt. It just becomes a reflex, just buy back stock. And I completely agree with Graham's view on this, that it's a neutral act. And what makes it good or bad is the price of your buyback. And when you're buying back a utility at 30 times earnings, I don't think that's good use of capital.
It's incredible that Telstra's at 30 times earnings now. There's another aside. But anyway, each time I look at my Telstra phone bill, I understand why.
Goes up 30 times every week.
Yeah. So generally then you want a company to be buying back stock, unless, of course, they think there's a better use of for the capital they can in investing in growth, I suppose. But generally, if the price is what we perceive as being fair or undervalued, then buybacks are a pretty good idea.
Do you know what the problem is, John?
What?
The issue is, I must say, I don't love buybacks. I'm in the minority. I think the market generally likes them, but I don't like them because when companies typically have the free cash flow to be able to buy back shares, the share prices are generally elevated. And when the prices are low, they don't have the share price wouldn't be low if they had excess cash flow. So very rarely do buybacks actually make sense. We're lucky in Australia we got the dividend system, and dividends are a great way. Look at the coal miners; they just shovel dividends down your throat whether you want them or not. And I think they're very sensible to do that. But in America in particular, this buyback culture is extra. It's just the default thing to do. You just dumbly buy back shares. And I don't think it's a good use of capital most of the time.
I think the Apple case was in the US at least, an example of a really, really good buyback. The company was kind of hated. It was very cheap. It was throwing off huge amounts of cash. It couldn't really invest that cash at the extent it wanted to because it was already a dominant monopoly. That buyback ran on for years, and I don't know how much of the company they bought back, but boy, was it a really, really good investment.
That's a great example. Yeah, when there's a clear disconnect between the cash flows and the price, that's where that makes it's one of the best things you can do is to buy back your own stock. But very, very rare circumstances is that possible. It's quite exceptional to see that, and it's a sign of a great team, a great management who are able to capture that opportunity.
Right. So, Graham, Gaurav thinks that companies do buybacks at the wrong time. What's your view on that, and why would they do it at the wrong time?
Yeah, I think he's exactly right. And you can kind of see it happening right now, where there's more than 20 stocks or so doing buybacks currently on the ASX. Back in 2020, that number was just 10. So you've got twice as many companies thinking now is the perfect time to be buying back stock, despite the share prices all being way higher than they were 5 years ago.
Right. You got to remember that was in the middle of COVID when stocks were incredibly cheap and we had 35 stocks in our buy list and there was hardly any of them doing buybacks.
Exactly. And it shows that managements are just as susceptible to emotions as investors because they were there thinking, oh, geez, this is a little bit shaky. I don't know if we should be doing this. Whereas now when markets have been going up for years and years and everything feels good, they've got the cash flow flowing and they feel more encouraged to be purchasing their own stock at these higher prices, even though it could be destroying value for shareholders underneath.
Right. And then there's a performative buyback where a company announces a buyback but doesn't put much money behind it. Why would they do that? That seems like a complete waste of time.
Well, it is, I guess, from the shareholders' perspective, but from management's perspective, they might think that it has some value in boosting the share price. So either because they have stock that they want to sell themselves or because they need to increase interest in the company for some reason. It might be a new startup or something like that. And so a higher share price would help them out in that way. And you do get buybacks for all kinds of reasons. But some of the worst ones, I'd say the number one bad one is when companies buy back a lot of stock at a really terrible price, because then they're just destroying value. But the second worst kind of buyback is when they announce a buyback and hardly do anything. It's completely performative. They're just wanting to make the announcement that they're going to buy back stock, hoping that people see that as a positive sign or a bit of trust in the company, and so start bidding up the share price themselves.
Okay, I think we will end the podcast there on the performative buyback. Gaurav's got to go off and cook a massive bowl of pasta for his hungry son. Thank you very much for your time, Gaurav. And to you, Graham, thanks a lot, and we'll be back in 2 weeks.